Hey everyone, welcome to another edition of the Buddy Study Group. Really appreciate having everybody here today on what is for many an extended vacation sort of week. So I thought it would be a good idea to continue our study hall series today. We covered hybrid long-term care very recently. We did a short-term care roundup that you could consider a study hall pretty recently. Time to go to traditional long-term care. And traditional long-term care, as we know, is Old Faithful. So what I'm going to go through for you today is really an introduction or review of some of the predominant strengths of traditional long-term care. Some you know and love, others I think maybe deserve a little bit more attention. So speaking more from a market standpoint, then we'll go ahead and review some of the leading carriers in the traditional long-term care space and have a discussion about that. And then I'd kind of like to open the floor to you all to um, be able to talk about your experiences, what you like about particular products that you think people could learn from that deserve more attention, news you've heard in the industry, and so on and so forth. And we'll just kind of all learn from each other in that way. But I'll kind of get everything started for us. So, traditional long-term care is the longest standing long-term care product. It's what many people think about when we actually just talk long-term care insurance in general. It has its massive strengths. It has some drawbacks and can tend to be the victim of justified or unjustified negative PR. I think maybe a little bit of both. But at the end of the day, still a fantastic, fantastic product, a solid option, and it's going to provide you access to certain sales strategies that are simply not available with other products. And that's why, we really want to bring these things to your attention or review these things with you because I know many have gone in the direction of selling more hybrid long-term care. There's a lot of innovation in the hybrid long-term care space right now, maybe a little bit less in the traditional space. And so there's a lot more shiny new things to go out and try with hybrid long-term care. And even the rise of alternative products have caused people to maybe go to a short-term care or go to an annuity-based long-term care or some other alternative product and maybe not completely stray from traditional long-term care, but maybe engage with it a little less than they normally would. So, um, that being said, traditional long-term care is still certainly Old Faithful. Um, I think with rate increase histories and things of that nature, again, it can get a little bit of negative press, but I think the actuarial science is far more reined in now because of those mistakes. Um, and I think one of the things I want to bring to everybody's attention is that traditional long-term care can be an affordability play. And that sounds probably very odd to you because the first thing people hear when they talk about long-term care insurance is that it's expensive, right? No matter who you talk to, if they have something negative to say about traditional long-term care or LTCi in general, it's expensive. I heard it's expensive.
Hey
Um,
Jason, I want to pipe in real quick on that point because
yeah.
I was taking the mandatory now California annuity 8-hour training. So you guys are not aware, as of 7/1, they have a new training you have to take in California. But in that, at a long-term care section, and it had a survey, what's the number one objection? And that was one of the test questions. 81% of people said it was affordability, why they weren't buying long-term care insurance. So just want to point that out, and that's the answer to the test.
Yeah, and I'm taking that just from anecdotes, right? So if you over time, if you get enough anecdotes, probably plays out in the data, but that's really good kind of supporting material. And you've been somebody who's actually a huge proponent of number one, show me the cost up front, but number two, show me that it is actually affordable. So, what in your journey kind of led you to be that proponent?
Yeah. Well, I think that you got to kind of address the objection head on
Yeah.
and say, yes, I can do that for you. Not kind of debate and say, well, this is what you need, but say, yes, we can serve you and support you with that. And I always love the idea that you can decide what your own price is for insurance. With most products you buy, right? The price is the price. But insurance, you buy what you want to pay, and then they tell you what benefits you get from it.
Right.
So that's why we look at Benefit Buddy and that leverage story, because you can dial that down or up and you're going to get the same leverage. If you get a better deal, buy more. If you don't know if it's as good of a deal, buy less. But it's really important establishing the foundation of professional caregiving and funding for that. So if you
Yep.
start with just the fundamentals and your goal being to get them some professional caregiving, I take the contrarian approach and don't use the cost of care usually early on. I use that later in the process once the client is bought into doing something instead of
Yeah.
nothing.
So I do have a little bit of a theory, and I think um, sometimes as a long-term care specialist, especially, we can tend to sell a little bit backwards from how we need to. So many times we have sold based on benefit, and we still do to a degree. I just think selling on benefit has become such a high concentration of the sales approach that when we do get to cost, we've set up all these benefits. I want that, I want that, I want that. And we get to a point where we look at kind of the grand total and it's sticker shock city, right? But I think we've been kind of making a little bit of a push for this, but I think it needs to be a bit more budget oriented. I think it needs to be a bit more cost oriented. Not only a little more upfront, but to support that great conversation that people are having on benefits. Because when you get a budget from somebody, you know what will drastically overshoot that budget and just fry any progress you've made with that client or prospect, right? So one of the things that we do in order to get to that point is really the group quick quote, or not the group quick quote, the individual quick quote in the buddy system that we have here, right? So one of the things that we have talked about internally is the Buddy INS team. We have calculators coming out of our ears, people, for group enrollments, for individuals, obviously benefit buddies, a story you know and love, right? We have been talking internally. We should show smaller defaults for benefits so that we can show affordability at its core initially as the first thing that somebody sees, right? So for a 50-year-old female looking at traditional long-term care, being able to show a default of 226 a month is not going to be something that's going to 100% blow the doors off, but it is a good default to start with. And by the way, this includes 3% compound and a 6-year benefit period. It's not as if there's the absence of benefits, but I think our approach here is not completely blowing their budget out of the water just to start, right? We want to show something that is affordable, easily doable, so that we can get them on board with probably their main concern is, will I be able to afford this? When we show affordability, we can go up from there. We can build that benefits conversation. If we're able to do a little bit more planning here, we can add a bit more monthly benefit. Um, you know, we can add different riders like shared care for couples. We can make enhancements to this plan, but I want to show where we can start at kind of a minimal level and still get something that's going to be meaningful for you and your family.
Yeah, Jason, that's a really important point that sometimes is lost is it's not where you start, it's where you finish. And your clients are very astute to ask about, is this enough coverage? They're going to tell you, give you buying signals even to where you can increase the budget. So it's not like this is where you're going to end, but this allows you to have a comfortable conversation where they're not immediately put off based on price and they're not really going to listen to the rest of what you have to say because they're still too stuck on this. Or you might have a spouse that's just unwilling to support it
Right.
because they're the ones that are stuck on price. So that you're just kind of like kind of taking down the guard so that they're empowered to feel like I can choose this, but I can also choose what's best for me. What's your recommendation? Also, if you are working with a high net worth client, you don't have to use this approach.
Right.
This is not about a script. If you know your client wants the richest benefits, right? They can afford it. You can start off with where you think is more reasonable for them, but you don't want to lose the client. And there's a lot of clients like that, even those that are affluent, that are just they're going to stop listening in the first 2 seconds if, the price point is initially too high.
Right. Because middle market folks still absolutely 100% have assets to protect and families to protect. And we don't want to lose them as potential clients at the end of the day. We want the conversation to end up in more victories for you all, right? So I think this is approach that's really realistic, but you gotta, know the audience you're in front of at
Case
the end.
Before you jump, though, can you show the hybrid one too? Because
Yeah,
I think, again, it's the same thing whether it's traditional or hybrid. You'll see the model here will actually let you run a simple, again, quick quote. And this is not carrier specific, it's just kind of giving you a starting point with a popular product just to kind of have a more reasonable conversation. Because even more so on the hybrid side, there's definitely an affordability concern there than on the traditional side. So I know we're
right.
talking about traditional today, Jason, but I just wanted to point
And
out.
I think on the hybrid side, Mark, there is a lot more I guess I'll say flash to the benefit conversation. So I do think that also causes a little bit of a gravitation. If I can really get across that live, die, or quit proposition, right, and the advantages there, um, I can still have that benefit conversation and come away somewhat successful in many cases. I think with traditional and having to, in a sense, overcome that use it or lose it stigma. That's where we need to go to an affordability play. And I think even if we start here and the client thinks this is a little bit steep, again, just know we have assumptions built in of a 6 year. We have assumptions built in of 3% compound. So we can adjust other things from here. This is to give you a back of the napkin starting point. We can go into Benefit Buddy and really kind of drill down a little bit more, or go the formal quoting process and drill down a little bit more. But I think that's one of the things I really wanted to discuss is traditional long-term care tends to bear the brunt of the long-term care industry stigmas overall. Certainly not all of it is warranted, and I think there are ways around that and just a little bit of a shift in the discussion. Um, but a couple of other things that I wanted to talk about on the traditional side is what's new. And there isn't a whole heck of a lot that's like super flashy, but I will say that the traditional long-term care industry has been listening to agent and consumer feedback, and there are some real meaningful changes coming from that. Number one, I've heard from multiple carriers that they're addressing some of the key um, pieces of feedback. Number one, kind of a smoother application process. I think one of the biggest leaders you've seen there is NGL and their new e-app platform. Very nice and sleek. Um, got some automation in there as well to really advance some pieces of the process while you're filling out the application. They've taken in a lot of information and have turned that into some real good on that side. Um, and I think one of the other things, it's really new business and underwriting where I'm seeing a lot of the advancements, the innovation. Um, but also on the back end, when the application is submitted, platforms like eNoah is one you're going to hear quite a bit from carriers, are really, really helping to cut down the time that it takes from the time an application is submitted to policy delivery, right? Like approval and delivery of the policy, in some cases by weeks of time. So that's something that folks have had complaints about in the past is that I submit this business and it's taking me 1 to 2 months to be able to get to the point of policy delivery. I can tell you that carriers are listening and carriers are making very good improvements on that front. Um, and then on the underwriting side, I think there are certainly some conditions that carriers are starting to get a little bit better on. Moo just recently had some reclassification on how they treat family history of Alzheimer's and dementia. There are still caps there, but they've kind of allowed for a little bit more breathing room for those with one parent or, first degree sibling with a history of Alzheimer's or dementia. It still remains a challenge, certainly. But I think even as Alan Gregoire said on his study group talking about underwriting, build relationships with underwriters, get yourself that credibility, get yourself that relationship, building that rapport, and you may be able to get yourself some flexibility from the underwriting side. But I would say just those biggest innovations that I'm seeing are really on kind of the structural, logistical, or underwriting sides of things to make sure that the traditional side of the business speeds up faster. Um, and I think carriers like NGL, with their current essential long-term care product, are making traditional a little less one-dimensional. 10 pay, single pay. We have Thrivent with a 10 pay as well. So it's not like this is just a monthly or annual premium for life product in all cases. We do have some um, we have some, premium flexibility there. It's not purely an affordability play. I think that is a good way to frame it in order to have better conversations on the traditional long-term care front. But for high net worth clients, there are some limited pay options available, and obviously being able to provide really robust, pure long-term care coverage. Um, so we also have the individual product buddy tool. We do have a one pager here that you can download on traditional long-term care that will give you kind of some really good specs and will really segue me into one of the biggest and most overlooked reasons to look at traditional long-term care. We talked about middle market folks still having assets to protect, even though they might not have a large amount of income or savings from which to make a premium payment. But the partnership program is really, I think, criminally underrated by long-term care specialists or anybody who writes long-term care insurance, because this allows, state depending, for extra asset protection above and beyond what the client can actually purchase for themselves, right? So not only can we talk about something that fits the budget, is a manageable premium and a meaningful addition to their financial plan just from the policy benefits, but the partnership protection in providing dollar for dollar asset protection to add to that Medicaid floor, to raise that Medicaid floor is super important for most. That allows them to retain key assets like a home, like a car or two, things of that nature. We've had specific study group sessions, and we will again soon, about the partnership program and the Deficit Reduction Act, right? That can really make a difference for those middle market clients to be able to purchase something that fits their budget and realize very robust asset protection. This is traditional long-term care only, folks. This is the only product that offers protection under the partnership program. So state by state, there are rules, so I'm just going to speak to it from a general perspective. But if you are not looking at the partnership program for, middle market clients, it's something you should absolutely be considering. And then, of course, business owner tax deductibility is huge. Of course, hybrid has kind of risen to the occasion in many carriers offering separately identifiable long-term care premiums that are deductible for business owners. But traditional long-term care, the whole darn thing is long-term care. So that gives you a much larger, portion of premium to be able to deduct. So for HSA owners, for business owners, HRA owners, just a super important piece to consider as well. And again, we're pushing for affordability, right? An affordability play for many. And spousal discounts tend to be, in my opinion, industry leading. Of course, NGL does that, um, joint case with one premium, which is very attractive in certain scenarios, but 15 or 30% discounts with other carriers based on two spouses applying together, or 15% if one is married, and applies and the other spouse does not apply. And then inflation protection, I think especially I want to give a shout out to Mutual of Omaha here as we go through all of the other carriers. We'll go through that a little bit more in depth, but I think the ability to tinker with the inflation protection is a huge advantage on the traditional long-term care side. Again, we're seeing hybrid carriers adjust to that just a little bit. But I also think a very, very, very nice advantage of traditional long-term care. And again, the gender value here is for men, with no life insurance component here, all long-term care makeup of the product. You know, Men, we get ourselves into a little bit of trouble or we don't listen and we kick the bucket earlier, so we tend to get better premium deals on the traditional long-term care side. So just don't discount that either. Um, but overall, this is a really helpful piece to help introduce clients to traditional long-term care or get your eyes on some ideas that may help you have more conversations around traditional long-term care because still a very, very, very solid industry-leading product type. So when we go into the individual sales guide here, and it has taken me a little bit of a minute to load here. Now, we do have Bankers Life. We covered them in the short-term care section quite a bit, so I won't harp on them as much here, and we'll have individual sessions for all of these as study group calls. But right now, we're kind of focused on NGL, Mutual of Omaha, Thrivent, and again, that Bankers option thrown in there. Yeah, Sharon, you make a good point. Really good for younger males as well. That cheap inflation protection, nothing to sneeze at. So definitely recommend checking it out there. But we also have a page for getting to know traditional long-term care. And if you want to look into this, this is kind of like where are the product sweet spots, where are the cautionary areas, and then we talk about other products that you may only have access to through a career agent or something of that nature. So New York Life, Secure Care, and My Care. Northwestern Mutual's Quiet Care can tend to be a pretty popular product out there. Life Secure is kind of in and out, but we do list them there because they are technically still kicking around here. So again, we talked about affordability. We talked about great value for healthy couples. Shared care rider still remains huge. I know there are joint survivorship, hybrid long-term care plans, but shared care tends to be a really, really great choice. As far as value for your dollar as an add-on to traditional plans for couples, especially NGL in this case, the third pool shared care offering, um, you know, extra benefit kind of above and beyond what partners would normally share with other traditional plans is a huge, huge advantage. Tax advantages, partnership protection again, inflation protection, and then being able to prepay or limited pay with certain products. We talked about underwriting, customer experience, product guarantees. Um, Product guarantees are another kind of cautionary area with hybrid plans. You can, again, get kind of fully guaranteed, fully paid up benefits. You may not always get that experience. You're likely to not get that experience, especially on a pay-as-you-go sort of model, with traditional long-term care. But again, Traditional has done a great job of kind of understanding some of these cautionary areas and doing a lot of work to make sure they shore that up. Anybody want to speak to, does anybody have experience with the kind of captive products that I mentioned, New York Life, Secure Care, and their My Care plan, and Northwestern Mutual Quiet Care? Now, I can offer some advice if you're up against Northwestern Mutual, because I was financial rep with Northwestern and did sell some of their long-term care in what feels like a past life. I would say it's a solid product. My parents own it. I do not plan to move them from it. But one of the things you will see in a competitive scenario is happen to be a good option for me as well because my parents live in New York and that can be a pretty tough state sometimes. But if you're ever up in a competitive situation against Northwestern Mutual, I will say that their inflation protection tends to be very expensive and tends to be a little tough on the value when you consider how their inflation protection is structured. They're generally offering inflation protection as an AAPB or an automatic additional purchase benefit. Essentially, it is somewhat similar to a step-rated inflation protection. Your premium is scheduled to go up as your benefit goes up. And in many cases, as you get into those older, more average claim ages, the premiums can get prohibitively expensive. Of course, you can pull a release valve and stop the premium increases. But you know, not all folks are kind of educated to that point. And I think it's especially upfront that conversation isn't happening all too much. So that's one of the really good things you can poke holes in. But I will say many advisors at Northwestern Mutual can tend to show illustrations without inflation protection to avoid that bad conversation. So that's just something to think about if you're in a competitive scenario there. Great product, but it is a key piece that generally goes unspoken. Um, does Northwestern Mutual's long-term care inflation raise the daily benefit but shorten the length? I believe I believe it just simply raises the access amounts, doesn't shorten the length, but it does increase their premium generally every year on a schedule. Yeah, Robert, if you would like to share a little bit on New York Life, I didn't even see you come in, otherwise I would have called on you directly. Happy to hear from you on the New York Life side.
Can you hear me?
Yeah, got you loud and clear.
Hey, Jason. Um, yeah, so some similarities with NGL. It does have a third pool of benefits.
Mm,
The only thing you need to watch out for, both couples have to qualify with a preferred rating. So if one gets what they call their select standard rating, they lose that third pool. I'm
yep.
hearing there are going to be some changes coming up to that product, so we'll wait and see. One of the things that none of the other carriers have are dividends.
Yep.
Northwestern Mutual does have dividends, but they are not paying dividends currently. Now,
That is true.
the dividends cannot be taken as cash. They are used to offset premiums. They don't start till year 11 of the policy, and they will increase as the insured ages. One of the other distinctions, they have a restoration of benefits that's included no matter what rating you get. So if you have an interim care need and you recover from that need, and 1 year goes by and you don't file another claim, they will actually replace what you received in benefits.
That's nice.
Yeah. So
How about on underwriting, Robert? We had some folks asking about for the captive carriers, what's the
yeah, good
underwriting like?
question. So New York Life's pretty lenient with underwriting. Um, they have a better BMI chart than Mutual Omaha. It's not as liberal as NGL. I mean, I think we all know NGL has the most liberal BMI scale out there, but it's not as restrictive as Mutual of Omaha. I will say they are not automatically pulling APSs or medical records for people 59 and younger. So I've had some instances with people in their 50s. I had one lady, she received we got an approval within 24 hours. a male in his 50s, and approval in 1 week. So they are looking at ways to simplify underwriting.
Okay. Thank you for that insight. That's really
Yeah.
helpful.
And
Restoration was very interesting to me.
yeah, and then the last thing I'll mention is they have a lot of options on the inflation side, 3% fixed. There's also 3% simple, but what people don't may not be familiar is their floating rate. So it floats whatever the CPI is in that
Right.
given year, and the client has the option to accept or reject it each year. And whatever they answer doesn't impact them getting that offer each year.
Hmm.
So if you've done historical, looking at the CPIU, that's the index they'll use. Over the last 20 years, that's averaged, even 30 years I've looked back, it's averaged like 2.6%. So close to 3%. So if people, are looking at New York Life, use that floating rate option. It'll be competitive with a 3% fixed, but the premium will be a lot lower.
Yeah, that's interesting to me. I knew New York Life offered a CPI. I was going to ask if they were still offering that.
Yep.
Not many carriers are offering that today, though it was a little bit more common in the past. But yeah, just another inflation protection option to keep benefits growing, right? Especially for younger folks, but keep the premiums down. And I do like that the offer's not going to be snatched out from underneath you if you say no in any
Yeah.
given year.
It doesn't
That's a really
matter
cool piece.
what you answer. They will always give you that offer every single year.
And then with regard to the dividends on Northwestern Mutual side, um, yeah, not a product they have historically paid much of a dividend on that I know. And it doesn't surprise me. They will generally bend over backwards and do whatever necessary to be able to pay a dividend on the whole life product, even if that means having to not issue a dividend on some of their other products. So that makes that makes a lot of sense to me. Well, I appreciate you chiming in on that, Robert. That really helps
You're
for
welcome,
those of us
Jason.
who don't
Yep.
have the day in, day out access. Let's see. Jackie has a question. Do you know the percentage of claims being paid from hybrid and traditional? Would like to see the comparison, even though I would just think there are more traditional. Just curious. Yeah, it's a really good question. I would have the same assumption that traditional just being around longer, being the popular option for longer is going to have more claims. Mark, do you have any data on that?
I do not, although the AALTCI, Jesse Sloan, kind of publishes some data on the overall industry claims data. I think it's like you mentioned, mostly traditional long-term care, which I think is probably around 14 or 15 billion dollars a year.
Hmm.
So that's the only number I know kind of that's out there. I haven't seen anything on the hybrid side though.
And just while I got you, Mark, I just want to say one other thing about traditional long-term care that's kind of maybe not a innovation but a reinvention is we are likely to start seeing traditional long-term care solutions coming to the group space. Now, there are a couple of individual carriers that are offering group discounts like a common association or employer discount like Mutual of Omaha does, or NGL has a specific group underwriting class that they offer and some various other concessions, but we may see traditional group geared products. Um, any thoughts on that? I know
Mhm.
from our perspective, it's pretty funny because all of the really predominant group plans are hybrid plans right now, but we get asked quite a bit for traditional, or we get asked for a lot of the advantages that traditional long-term care offers, like tax deductibility, because group plans don't have separately identifiable long-term care premiums as of yet, or inflation protection, right? That doesn't exist on all plans. So, what are your thoughts there?
No, I agree. It's really exciting. to have new products, to have a category that's being kind of reinvented, having not had traditional in a long time. And I agree that the group model with guaranteed issue is very different even than a simplified issue model. So there's a lot of kind of flavors of this out there. But yes, I do think there's going to be new traditional options, plural, that are going to come into the group market. In fact, I know there's three new traditional carriers that are coming in. So it's likely those carriers are going to rethink, and have the ability to build something from scratch, where some of the existing carriers may not have that flexibility. And to your point, Jason, absolutely, it's going to take advantage of so many of those advantages. I had an employer conversation this morning, that very well-funded technology company. They said, "Hey, we don't have unlimited funds, but we'd like to prepay 15 years of this group policy as a lump sum for everybody, because right now there's no time value money concern here." That's what they
Sure.
said to me. Like, wow, I would have loved if I had even a hybrid product that I could have been able to prepay 15 years worth of premiums. With traditional policies and the ability to deduct it, to your point, that makes potentially a bigger difference in those type of cases. So, and they're not the outlier. We're hearing this pretty regularly. So yeah,
Yeah.
it's exciting to see the innovation on either side, and then you can again present it side by side, just like you do on the individual side, see which one's the best fit. Because some of your clients are going to love the hybrids and the advantages there. Some of the clients are going to love the traditional and the advantages there. You want to have both.
And then just one more thing. Since you are exposed to a lot of product and, we've seen the popularity of the Banker's Life product and what they've been able to do creatively
Hmm.
from that standpoint. Um, do you think traditional carriers are thinking about, and if not, should they be, kind of a minimal exposure, traditional long-term care product that can still offer things like partnership protection, like a very solid compounding inflation protection? And why do you think they haven't done that as of yet?
Well, I think it's very easy to say that the jury has come back,
Sure.
and it is very popular to do a short-term care style product filed as long-term care. So if you look at Bankers, they are the only carrier that grew significantly in the LIMRA survey last year. Not only did they grow, they doubled their production. I think they sold 15,000 policies in 2024, only mostly through career distribution and folks like us that are specialists, compared to the next carrier, which had 6,000. So they're 2.5 times the size of the next carrier in terms of policies sold with that concept. And we know short-term care is getting more popular, so why wouldn't a carrier, if they're comfortable with short-term care, file that style product as long-term care? There's a little bit of extra licensing, as we know, LTC certification that agents have to do, but that's not a real barrier to entry.
And certainly when you're building a product, you have to rethink the underwriting parameters for a limited exposure product. You have to give
Yeah,
probably some more concessions because you will not be on the hook for as long. So there's stuff to
sure.
reinvent, right?
Sure. But that's what short-term care has already done, though. So it's not
Right.
like you're taking extra risk over
Right.
what you're already doing. You're just getting a product that instead of being in 35 to 40 states is in all 50 states with partnership protection and a lot of the features that are going to really enhance the core offer. So yeah, if you can do it smart in terms of limiting the exposure, like you said, Jason, to a 1 year exposure, the product is priced more conservatively now, to your earlier comments in that as well. I think that's a great fit for the market. I'm sure some other carriers are going to copy what's working really well for Bankers. We don't have to guess at it. We see their sales, we see the success of their program. So why not, the carriers love to be second movers to things that work really well. Well, that's a clear opening. Maybe it's already happening, we just don't know about it yet.
I mean,
But
we're not like clairvoyants, right? If we're thinking about it and another carrier has already done it, there are plenty of people in
Mhm,
rooms at carriers all over the country who are thinking about it.
mhm.
Just
And
an
by
interesting seed to plant for the
Yeah,
future,
and by
right?
the way, you could even combine the two concepts and build a
Right.
group short-term care, long-term care product, again, which gets you access to a fast-growing employer market at the same time. So again, and you could even have a retiree type of offer there, because the 65 plus market really likes the short-term care, and I think they'd like this long-term care concept too. So many, many opportunities in the marketplace. You just have to look at what's working. I know we have some carrier people on the calls too, so hopefully they take it back and we'll see these designs coming into the market here soon.
Yeah, and I think even though there's not as much flashy things going on in the traditional space, it just has some inherent advantages that you cannot get anywhere else. And that's what makes me so excited to potentially see it branch out into things like the group space or just brand new plan designs because there truly is a lot to like. And sometimes, like just doing study halls like these, we just have to kind of stir up the water a little bit and remind people of sales ideas that have been there all along, but there are so many different products, product types, and plan designs out there in the market that we just kind of forget them or walk right past them sometimes. So just a good piece to know. And then looking at NGL Mutual of Omaha and Thrivent here, I think to wrap it up, I'm going to say a couple of things I like about each carrier, and feel free to chime in with what you like. But NGL, third pool shared care, is very, very high on my list as an advantage. Talked about that before. But I also just like that they're kind of a Swiss Army knife at present, 10 pay, single pay options, even some return of premium options, the likes of which are not seen with other products, just kind of allow the ability to craft something, some way that a client can say yes to benefit wise. It's all about kind of reining in those riders and picking the right combo to make something that's affordable. But I think it's a very long-term care specialist orientated product because we are tinkerers by nature, right? We can help somebody tinker with the plan design and the benefits until we get to something they really like. Um, so that's something that really has me excited. Yeah, Jackie kind of mirroring that with the third pool, pretty unbeatable as far as I'm concerned for couples. And the two partner, one premium sort of concept, the unified premium there is a pretty interesting design as well. So they're always worth a look in couple situations to see if you have kind of a favorable outcome for that pricing structure. Um, for Mutual of Omaha, um, you know, rock solid consistency to me, like um kind of like a no news is good news kind of carrier in my mind. But the thing I love about Mutual of Omaha the most is the custom solution product, all of the extra riders that offers, but especially um the amount of variance that you have on the inflation protection. I think that's massive. I think other carriers should copy it in some way, shape, or form. Being able to work with a 1% inflation protection option for, folks who are of that age where they've got a lot of financial obligations. They've got kids to put through school. They're paying for organized sports. Daycare costs more than a mortgage, but they understand that long-term care is an extremely important thing, and having a benefit that grows over time is important. You can start with a 1% compound. You can even put a 20-year or a lifetime on it, or several other increments, and you can keep premiums affordable today, and you can buy up in later years as income provides. So you can even buy down in those later years. When you start to gravitate more toward a fixed income, you start gravitating more toward the average age of claim, and you can buy down to lower levels of inflation protection, even down to, say, a 1%. So I think it's a really good product, again, for specialists who have great relationships for their clients and conduct regular policy reviews. It's a great discussion to be able to have a plan that allows you to, in real time, fit the policy to where the client is financially in life. Um, and then Thrivent has a number of states that it is quite competitive in. I really like financial strength. Number one, 100 Comdex is nothing to sneeze at. But also that they offer a 10 pay. I really love their 1 equals 7 elimination period. that is a big one for me. 1 day of service in a calendar week gives you credit for the whole week. It's not a full calendar day elimination period like Mutual of Omaha. Calendar day and monthly is another real big advantage of Mutual of Omaha in my opinion. But the 1 equals 7 is kind of a nice intermediary if we've got service day elimination period. Shout out to the underwriting niche that we learned as a part of the Washington CARES Act with Thrivent. They'll consider currently pregnant women. So if you've ever run into that, Thrivent actually will, consider currently pregnant women. Um, but at the end of the day, they've got a few states that they are incredibly competitive in. I'm seeing them kind of become more and more competitive over time. Um, and I really love all of their quoting tools. Their quoting area is very, very slick. We'll see a lot more attention paid from the carrier side on um, their traditional long-term care product because Care Forward is pulled from the market. So we'll kind of see what they do to kind of improve the traditional long-term care product now that they kind of have that renewed singular focus. So I think a lot to like. Again, another really rock solid carrier that offers a lot of really good sales tools, offers a 10 pay. They've got some flexibility there, some decent underwriting flexibility. They've got a number of different inflation protection options as well. 1, 2, 3, and 5% compound can be an annual or flexible increase. Um, and again, just really well rounded as far as I'm concerned. Anybody have anything else they'd like to chip in with that they like about any of these three carriers that you think are special, have helped you in certain cases, maybe a certain benefit that has saved or won a case for you?
That's a good question.
Of course you can.
Thanks. So Thrivent, so the flexible increase, so in the inflation, so can you tell me how that works?
Yeah. So I'll sh reshare for you.
Thanks.
So the flexible benefit increase is available for ages 18 to 70. It's an all or nothing benefit increase. So they will increase by 5% compounded unless the insured opts out. And that would mean no benefit increase in that year. Premiums increase with each benefit increase. So think kind of like step rated. Um, Automatic increases will occur if the insured is on claim. If three consecutive benefit increase offers are declined, then there will be no more future increase offers. So
Oh,
you kind of got to watch your elections there, but it's three consecutive. So we read these things by the letter of the law. So you can kind of pick and choose and space it out when you'll see
well,
increases there.
mm,
Not available with 10 pays, but available with the pay-as-you-go modes.
well,
So
thank you.
annual increase is just kind of what you see is what you're paying for, and you're going to have 5% compound on it as you go. Of
Thank you.
course.
I have a
Okay, so
question that's not related to traditional if there's time, but I'll
Hmm.
wait until anyone else has other questions.
Yeah, who's got it? I'm all ears. Anyone else with any questions?
I just had a comment on the NGL
Yeah.
plan. I was able to show it and position it against a hybrid for a couple because they offer the joint.
Hmm.
And I liked how it priced on the 10 pay. And also with that 10 pay comes a guarantee.
Yep.
It's paid out. I mean, when can you have a guaranteed paid up policy on a traditional? That's just not the norm. So I really like that they went there, and I think it's a niche opportunity if you're shopping out for clients and they need something a little more affordable than that hybrid premium.
Yeah, a super big advantage working for NGL and Thrivent. And for exactly the reasons you stated, right? I can built in the box overcome the objection of potential rate increases. It's not a single pay paid up guaranteed no rate increases, but it's a lot less likely that you're going to see a rate increase in that 10-year window, um, as opposed to on a pay as you go, you open yourself up to a lot more exposure, right? Get it off your plate after 10 years at the end of the day. Totally agree.
But that 10-year premium I'm saying is guaranteed.
Oh, yes. In
So there is no
NGL's case.
increase.
Yep.
And it's almost like to me, it competes with that hybrid. They're not getting the death benefit and the cash value, but if their
Yeah.
primary goal is LTC, that's the way to maximize it.
Yeah, and if you're in front of the right client, especially folks who are a bit higher income, a little bit more affluent,
Mhm.
oftentimes their main concern is how quickly can I get this premium, off of my mind, out of my mailbox, right? To have to pay at the end of the day. So, yep, really good point. Anybody else with any questions, comments before we take it back to Suzanne? All right, the floor is yours.
Okay, thank you. So I have kind of a funny fact pattern. So a woman inherited a non-qualified annuity from her mother. The mother passed away in 2022, and the daughter has been sitting on it and hasn't done anything. And so now the estate planning attorney is coming to me saying anything creative we can do for long-term care or for something to avoid taxes or to give her some kind of a benefit. But I mean, it's Bright House, and they're saying that she would have had to do a 1035 exchange by the end of the year of 2023,
How old
a
is the
year after,
client?
in her mid 50s.
Okay.
I'm just wondering if anyone's having any thoughts in terms of options for something with creative long-term care using that, but I don't think we can do the exchange anymore because it's been so long, but I'm
Yeah, I wouldn't
curious.
be able to speak to those particulars, but whenever I hear existing annuity, not a ton that it's earmarked for specifically, I always think Pension Protection Act with annuity long-term care, especially somebody
Mm-hmm.
in their mid 50s,
Mm-hmm.
is just starting to be in that eligible age range for a lot of annuity long-term care products.
Right.
Underwriting tends to be lenient and in some cases guaranteed issue with Equitrust
Mm-hmm.
Bridge. So there's a lot to like there. The leveraging the PPA is, one of the best things you can do with an annuity with significant gains.
Right.
Um, so I can't speak about the specifics of is this currently eligible for 1035, but if there is, that'd be my recommendation. If anybody else has recommendations, definitely feel free to toss those out. Um, but
It
yeah,
doesn't know if it's not qualified. Is that already determined?
It's non-qualified.
And it's annuity, yeah. I guess the
Doesn't Lincoln have
1035
a
strategy
long-term
would
care
work well.
annuity?
Sorry?
I'm sorry. Doesn't Lincoln Financial have a long-term care annuity? So if you could 1035, you could do it into that product.
Yeah, there are a couple of different products that are out there for long-term care annuities. We got that in our individual sales guide as well. One America Annuity Care,
Mm-hmm.
and I would say they have experience in dealing with some pretty hectic exchanges. They'll
Right.
do all sorts of gymnastics, so their advanced planning team is magnificent there. So you may
Right.
find even if One America is not the actual solution for your client, you may find some really good folks over there to talk to because they've dealt with every which way of
Mm-hmm.
situation. Um, but also, yeah, I would keep Equitrust in mind if underwriting may be a challenge there, if health may be a challenge.
I don't think health is a challenge. I
Okay.
think health's okay. It's
Um,
more just the mechanics and, anything we can do. I'm not sure how much gain there is, but I'm guessing it's probably potentially significant.
Yeah, if it's significant and it's a possibility, mitigating that with a PPA eligible
Right.
7702B long-term care
Mm-hmm.
annuity is huge.
Right.
Care is another carrier that you could look at as well. Based on underwriting, they do a 2 or 3 times benefit doubler. That's another one that's good to kind of compare and spreadsheet there. And this is impetus to get an annuity study hall scheduled so I can think of a couple of folks who might make a good panel that I'll put together for that because, there is a base knowledge that is good to have about annuities, and then there is the long-term care specialty to add to that. So that's something that'll be coming up soon. I'll start to shake the trees with a couple of people I know
Excellent.
are
Okay.
well equipped for the job there.
Thank you.
Of course, happy to help. Anybody else have any questions, comments before we wrap it? We got about 3 minutes left, but I am more than happy to set you free and give you those couple of minutes back.
Jason,
Yes, Sharon.
which standalone carrier has the lowest age?
The lowest age, great question. I believe that is Thrivent. Thrivent goes down to age 18.
Oh, okay, great. Thank you.
Yep, and that was another niche we really had to take a look at deeply with the Washington CARES Act. When you have to insure almost any type of individual because they're now all asking about long-term care. You get a lot of information. Um, but then I believe.
And they will look at current pregnancy as well,
Yeah,
right?
we covered that one too.
Yeah.
I always feel remiss to not mention that just because of the way it was learned. Very interesting. Then Mutual of Omaha, I believe, and NGL from there. Captives are a different story, entirely. But I know Thrivent goes down to 18, and yes, Lori, you make a really good point. Thrivent does have an attestation of faith as part of, their fraternal nature, so they will have you attest to being a Christian, attempting to live out your faith, or being the spouse or partner of a Christian attempting to live out their faith. So generally, that's something you want to broach kind of ahead of time. If it's an issue, you can move on. If it's not, a great product to be able to look at. All right, I think that will do it. That's a great place to wrap it. Thank you all very much for coming in and filling our gaps in information or just asking about specific cases so that everybody learns. Really, really appreciate that. You guys make this what it is. Um, One announcement to make, we will not have the worksite edition of the Buddy Study Group on Thursday. Um, I thought a lot of people would be gone today. Glad so many of you showed up, but I'm sure we'll have much, much less on the Thursday right before 4th of July. So we'll send you some goodies to chew on if you want to watch some recordings and a little extra content, just so we don't leave you with nothing. But I'll send out an email on that as well. Thank you very much. Have a wonderful Independence Day holiday, and we will talk to you soon. Have a good one.